Hey, Rent Retires. It's Adam Schrader here with Zach Lemaster for another podcast episode. And today we're going to talk about that which has been all the rage amongst our clients since we started adding it to our sheet, and they've seen the massive increase in numbers that is looking really good, and that is adjustable rate mortgages. We've seen these become more popular as our investor loans have gone up to 6%, which, for the record, is not crazy. I actually have loans from several years ago that are higher than that, but we've seen them increase. Rents haven't had time yet to catch up, so returns have been compressed. But now we have an adjustable rate option that we're pretty excited about. So we're going to get into that today. But first off, hey, Zach, welcome to the show.
Hi, Adam. How are you?
I'm doing well. So you went out and interviewed, I don't even want to know how many lenders to get this rate, because everybody I talked with was sourcing people who were doing adjustable rates, and they were saying, oh, they're pricing them to be the same as fixed rates. And then you went out and talked and you found a much better option. Can you tell us a little bit about what you found?
Yeah, absolutely. And I think this just kind of big picture here, Adam. This is something we constantly do. We're always looking for the best lender options. I mean, obviously, we're all investors ourselves, and we personally want to use those best loan options out there, but also make them available to our clients. And not all lenders are created equal. I think that's one thing that and people need to know is you really need to be doing your due diligence in searching for the best lender. Now, the lender recommendations that we've already done that for you. You can still go out and source other loan options, of course. But we've done that heavy lifting where, yeah, sometimes it takes interviewing and getting quotes from 50 to 100 lenders to see what kind of terms they have to offer the best investment products to offer the best cash flow. And we've seen a huge variance, especially right now. I mean, kind of talking about where we're at right now with interest rates, it's a little bit of a shock factor, right? Because people are seeing that interest rates are still creeping up. Really what's happening is our interest rates are just getting back to normal. This really is where interest rates should be. I know it's kind of painful to hear that for most people when over the past 2 to 3 years, we've all gotten very comfortable in feeling like the norm is historically low, all-time low interest rates. And that became the norm at that point in time. But really what's happening, this is a necessary thing, is to get interest rates normalized to where they're at today. Of course, we have 40-year high inflation. The Fed's trying to combat that. But a 6% interest rate, that is actually a pretty good interest rate. If you look at overall historic averages, you can still cash flow 6%. Now, if you're comparing it to, 3.5 to 4.5%, 18 months ago, obviously that's a big difference. However, it's important to be an astute investor and always look at what the best financing options are out there based on your goals, timeline, resources. And so what we've done is found an alternative lender solution where you can do an adjustable rate product. And we'll talk a little bit about what an ARM means and what that entails. But we have ARM products that we're seeing people get as low as 3.75%. That's a significant drop, where a property that maybe didn't make sense at 6%. I think all of our properties still do based on the cash flow, but that does allow an investor to come in, be creative, and be an investor that is using these creative options to still cash flow more in a period of time. So maybe let's start and just review what an ARM product is. Adam, do you want to give the bullet points and all my 2 cents on it as well?
Yeah, absolutely. So just so people know, these terms that are on the website that you're going to see at renttoretirement.com are all based, from what I understand, Zach, we're basing it on a 5-1 ARM, right?
Yeah, there are. What we're showcasing is a 5.
Yeah.
Well, I don't want to say 1.
Yeah.
So what that means is it's a 5-year. You actually have a locked interest rate. Whenever you hear an ARM, usually you hear 5, 7, or 10-year ARM. It's still amortized over 30 years, but that just means that the interest rate is only locked for that 5-year period. That is what we are showcasing, and we'll explain why. Now, the second part of that is like 5/1. The one part of that means that the interest rate has the ability to adjust every year. So if you see a 5/6, that means 6 months. Those are the most common two. So that just means the second number there is just the adjustment period.
Yeah. So you're seeing these, and they're locked at that 3.75 to 4.25. So we just put 4% to hit the middle and kind of cover any variance that's going to be there. But you're looking at that with the locked in rate for 5 years. During that time, most of them don't have prepayment penalties, so you can refinance out of it and get into a 30-year fixed if it starts to make sense, or if it's getting towards the end of your 5-year locked and you're worried about where it's going to go up to, then you can start looking at your 30-year fix. But I'm going to run some numbers by you here, and it's going to show that it's probably a pretty darn good option if you are concerned about the current 6% roughly rate that we're seeing there. So I have two different properties that I pulled up. One is kind of your average property that we have. It's 150,000. Well, it's 157,000 price point. And then another one, and that one's in Missouri. And this other one is a $212,000 property that's in Central Florida. So when you look at the numbers, I am using a 2% rental increase, which right now in today's market is absurdly low, but it is something that I think anybody could get pretty much any year.
That's a very conservative number. Yeah. Especially in the Florida market, we've seen a 22% increase in rents. Now, that may not be sustainable, but 2% just for if someone wants to be ultra conservative, yeah, 2% increases over time. And just before you go into the numbers, real quick, the whole idea, I mean, the question with the ARM is, okay, well, what happens at year 5? Right? I mean, if the interest rate, what happens at that point is the interest rate can adjust. And usually there's a ceiling or a floor to how much it adjusts. We all anticipate rates to be higher. But if the rates are lower, I mean, the rates would lower at a step down rate. So if it's a 1% ceiling, if rates are at 8% and you're currently at 4%, your rate would go up to 5% the next year. And then the following year it adjusts again. But really, I think the point we're trying to make here, Adam, is that because over that 5-year period, because of rental increases over time, your cash flow should well support whatever the interest rate is at that point in time. It really shouldn't be a concern if you hold that loan. Other options are potentially doing a refinance if there are significantly better rates at that point in time, or possibly selling and doing a 1031 exchange on the property. The average holding time for a lot of our turnkey investors is between 4 to 6 years. And that's just simply because it makes sense to sell the property at that point in time because of rental increases in time, but really the appreciation, the equity position you have through appreciation and debt reduction is significant enough that you could sell that property still early enough before you have huge capital gains, say in year 10 to 15 potentially, or I'm sorry, I said capital gains, capital expenditures with like roof and things like this. So it's kind of the sweet spot to sell it. You have enough equity to go out and exchange it and buy more properties. That's often what we see. And so you may not even need to worry about it. I use ARMs all the time, and I have for a long period of time. I currently have ARMs right now. This is just something we need to be aware of. Whereas in the past 2 to 3 years, no one cared about it because your conventional rates were just as good as an ARM product. So it's like, why would you even explore that? But these are a very viable option. So let's go through some numbers, Adam.
Yep. All right. So we're going to start with the Turnkey Rehab in Missouri. It's 157,000. It's got a rent of $1,250 on the property. And so, like I said, I'm using a 2% rental increase. So that means every year, and I'm not going to compound it by year, but every year you're raising your rent roughly $25 a month. As I tell people all the time, if your tenant is going to leave over $25 a month, you probably don't want that tenant to begin with. That's not somebody you want to keep in place, and probably not somebody who was going to get approved for the rent in the first place at your property. So you're going up $25 a year. You're looking at 5 years. So that's $125 a month that your cash flow is going to go up roughly in that time. Obviously, taxes can change, insurance might change, but just call it $125. But here's the thing. Every month, when you look at the 4% versus 6%, you are getting an additional $154 a month in cash flow, which takes your cash on cash from 7.3 all the way up to 12.2. And so over those 5 years, you are getting an extra $9,240 a month in positive cash flow without factoring in the rental increase. So you're already day one, even if rents stay the exact same, you're going to be over $9,000 ahead. Now, when you refinance, you are not going to be paying $9,000 in closing costs on your refinance. So no matter what, you're still ahead. You're going to be pulling money out anyway or selling, so it might not even matter, but you're not going to have a $9,000 closing on it. And so you're going to be in a very good position. You're going to be ahead one way or another in this deal with your arm. That's step one, I would say. And the other one, like I mentioned, is in Central Florida, 212,000 rents for 1650. So at 2%, you're looking at a $33 increase every month. Once again, that's not enough to make somebody move. So you're looking at $165 over 5 years, roughly, in rental increases. But in this one, your cash flow is actually bumping up $208 a month.
Yeah, those are good numbers to look at. And anyone that's looking to explore this option, I highly encourage you, just for educational purposes, to write out the numbers. We have a good calculator on our site that shows rental. You can plug in whatever appreciation rental increases you want over time. It shows you year or month by month, really what that would look like, and year after year, to help you run those numbers. But I think the point you're making, big picture, is that even if rents stayed stagnant, by having a lower interest rate at, call it 4% on an arm, you were cash flowing significantly more, give or take, in that $10,000 range over that 5-year period, which is significant. But then we assume, of course, that rents will increase over time, especially in this inflationary environment. Rents are absolutely going to go up in all markets that we invest in, and so your cash flow should be higher than the potential change in interest rate will affect the mortgage. And so your cash flow, if you were to hold that loan and allow the adjustable rate to come in on a yearly basis, you should be just fine if you run the numbers looking at that. And again, you have other options to look at. You can potentially refi if, say, interest rates are much lower. I mean, your rate would lower with that as well. That's the thing with the adjustable rate; it could go up or down. So I don't know if refinancing would even make sense. But more realistically, probably within that 5 to 6 year time frame, you're likely going to look at selling it and doing a 1031 exchange. So it may not even matter. And quite honestly, that's why I buy a lot of products with arm loans, because we simply, our exit strategy is not to hold it for 30 years. I mean, the 30-year fixed loan is something that's very unique to the United States. I don't think a lot of people know this, but I'm not aware of any other country that offers a 30-year
Yep.
fixed. We own property in Canada. My wife's Canadian. So, I mean, they don't have a 30-year fixed product there. All of their product, this is the norm. They have an ARM product with a lock period. This is how commercial lending works in the U.S. There's no such thing as a 30-year fixed rate. They're all on balloons, and it could be fixed for a period of time and then adjust, or a balloon, at some term of a loan. So I just think a lot of investors maybe haven't explored the ARM option or really don't understand it. And they hear the word adjustable rate and they get concerned with that just because they're unfamiliar with it. But if
Well, they
you
think
really,
back to 2007, 2008, whenever, you had the people
Mhm.
who were in they leveraged themselves too much when the adjustable rate came in, it hammered them. But, you
Oh
know,
my gosh. And those adjustable rate products at that point in time were just outlandish. I mean, it was, you could have a rate adjusting every 3 to 4 months or 6 months. It was just crazy. And when you're buying a house that doesn't cash flow in the first place, when doesn't have any equity, and just banking on the fact that it's appreciating, I mean, that just doesn't make sense to any degree. So yes, there's definitely probably some negative connotation from that experience with adjustable rates, but I mean, the feds don't even allow those products anymore.
yeah, yeah, it's a whole different ball game. I know they say, this time it's different, and that's the famous last words, but the lending world is actually fundamentally different this time around because of what happened previously. And so, I mean, when you look at if you just factor in maybe a 3% appreciation in your property, by the time you get around to year five, you're going to have, you know, 20, $30,000 in equity in of appreciation in the property, let alone your equity pay down. And you're going to want, I mean, no matter what, in my opinion. I mean, I'm at that point with some of my properties where I'm looking into refining because it just makes a ton of sense, even into a higher rate with my properties, because I don't care about that. I'm looking at it'll still cash flow. I'll be able to get money out. So you're going to want to do something. I mean, even if you keep the property, by the year five, you're going to want to do something with that property one way or another. And that's going to involve changing the loan. And at that point, you can just change it, and move forward from there. So I
Yeah,
think
and
that's
even
an
at
important
even
thing to
at
keep in mind.
Yeah, even at 6%, if you did want to hold a 30-year fixed loan, I mean, here's the reality. Most people are not holding their property for 30 years and paying off that mortgage. That's
Yep.
just a reality. Some people come into this with the mindset like I'm going to buy this property and just own it forever, and
My
that's
real
great.
estate investing's done.
Yeah, I mean that's the mindset some people have, and I understand that. And in some cases, maybe that is true. In the vast majority of cases, people are not holding their properties that long, and the typical holding time is 4 to 6 years. We've seen, and that's typically what we hold as well, because you got to keep your money dynamic. If you have equity in that property, maybe it makes sense to position that money into the next up and coming market. And I mean, that's really how you grow your net worth over time, is keeping your money dynamic. So I think really the argument is, would you ever even have, is there any point to ever have a, a 30-year fixed loan on a property in the first place? And I think there's a lot of argument out there to be had that really doesn't even make sense. As far as looking at your closing costs and things like that, often ARMs can be, unless you're paying points, I mean, they can be less expensive as well, the closing, which at the higher price point makes a big difference as well. But it's just something I would encourage everyone to look into and kind of understand. Also, interest only. People hear interest only options, and they really don't understand that, but they get concerned when they hear interest only. Well, if you look at a 30-year amortized loan, it's mainly interest only in the first years anyway. You know what I mean? You're really not paying a significant amount of principal down, just because banks front load that interest. So, I mean, those are just important things to look at. I think the ARM is a very viable product, but also with where we're at in the economy right now, rents are increasing dramatically. There's all-time low supply, all-time high demand. I mean, people need housing, especially in certain parts of the country. Rents are appreciating dramatically and going up. So I think even if you're at a 6%, usually when you're looking at a pro forma, that's year one analysis. And so year 2, 3, 4, 5 down the road, as rents increase, your mortgage won't change. And so your cash on cash return should be getting better year after year, as well as that property appreciating, loan being paid down, things like that. So those are important things to consider year after year performance, not just looking at year one.
Yeah, I mean, I track my cash on cash monthly with my spreadsheets because I'm a nerd like that. And most of my properties, at the 4 or 5 year mark are cash on cash somewhere in the 30 to 40 range. I mean, even factoring in the monthly mortgage payment and all of that. I mean, it's getting, every month it gets better, and then there'll be a little, repair that'll knock it down, maybe 1/4%, 0.5%, and then it just continues climbing. And so, I mean, it's I can throw out, I was telling you about an example of a property that I'm about to refinance out of, and I'll throw this out here before we start. But this is kind of something for people to keep in mind when they're looking at their long-term plan. I have a property. It was the cheapest property I've ever bought. You could not find this property now. It was a turnkey property in Memphis for $53,000. Obviously not in the greatest of neighborhoods, but turnkey property in Memphis, $53,000. Thanks to it was appreciating before COVID. It was probably around, it'd gotten up to 70,000 or so. And now with COVID, it's looking like it's probably somewhere around 110 to 115, somewhere in that range. And so we're looking at, and our interest rate's somewhere around 5.25. And so this was 5 years ago, people. So even if it just goes to regular, you're going to be in that 5 to 6% range, most likely in 5 years. And so we're looking at potentially pulling out. Remember, this was a 20% down, so we had $10,600 into this deal. We're looking at potentially pulling out $45,000 from this property and still cash flowing $150 to $200 a month. I mean, when we first started, our cash flow was about $250 a month. But because of rental increases, because of appreciation, we're able to position ourselves in a much better place than you would have looked at, year one.
I love that, and that just goes to show, I mean, how you can compound real estate over time. Really, this is a long game. I mean, just holding real estate in, looking at every year, reevaluating where your property's performance is at. I mean, yeah, you just hold a property for 4 or 5 years. You have enough equity to then pull out. There is such a thing as return on equity, and so you need to make sure that you're using your equity strategically. And so in your case, that property, your F-class property in Memphis in the war zone, I'm just kidding. Yeah, but you can't get those prices today. But some people would argue Memphis doesn't appreciate, but I mean, that's the reality is everything's appreciating right now. And so that type of property, obviously, it's still cash flowing quite well, even with a refinance, but even with higher interest rates, and you're pulling out equity to then go get a return on your equity, scaling up and buying more real estate. So that's a perfect example. I love that, Adam.
Yeah, and if the 5-1 makes you uncomfortable, like Zach was saying, there's a 7, there's a 10-year. You have the option. Obviously, those will be slightly higher interest rates, but you can lock it in longer, make you sleep if it makes you sleep better at night. So
just run the numbers. Run the numbers on it and see what makes sense. Say, if I plan to hold this property for 5, 7, 10 years or whatever the case is, because it's likely not going to be 30 years. What makes sense at that point in time, and what are the potential options? That may help you plan your disposition and exit strategy on the property as well, which I think a lot of people don't necessarily have that foresight. Again, it's like, I'm going to buy it and forget about it, which is great. You can forget about it for a certain period of time, but you need to reevaluate. If that property, if you're in an up and coming area in the path of progress and that property is appreciated significantly, yeah, maybe it makes sense to sell sooner. I mean, we've had some people that have turned around and sold properties in areas in 1 to 2 years and done it exceptionally well just because of the appreciation. And then they went and bought 3 or 4 more properties and 1031 it. So definitely something to consider. I encourage everyone to look at an ARM product, and it is a creative way to increase cash flow now, increase your overall returns, and combat the higher interest rates that we're seeing currently.
All right. Well, I think we'll stop it right there. Everybody, you can check us out at renttoretirement.com. That's renttoretirement.com. You can schedule a call with a strategist to talk over these things. If you've got a portfolio with a bunch of equity in it, we can figure out how to strategically deploy that equity. That's all at renttoretirement.com. If you have any questions, you can email us podcast@renttoretirement.com. That's podcast@renttoretirement.com.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.